Your debt to income is something that can make or break your home loan. And this is something I get a lot of questions about, especially when it's a first-time home buyer and you haven't had to talk about or calculate your debt to income before. What we do is we pull your credit report and look at the minimum monthly payments that are listed on your credit report. And those payments could be for a car note, a mortgage payment, your credit cards, a personal loan, anything like that. We do not look at medical bills. But we also take the 60 days of bank statements that we get from you and look for not only traceable deposits, because your money has to be traceable that's coming into your account, but also any payments that also look like they're going into any debts owed that are not listed on your credit report. So if you have some other loan that for some reason is not reporting and you don't tell us about that ahead of time, we will be asking about that. That is something that will be seen by underwriting, and they will request some sort of letter of explanation. And if it is a debt that is ongoing, it will be counted in your debt to income. And then when you look at making payments with things like Affirm, Klarna, Afterpay, those things can also affect it, because if you have those bills, even if they're not showing on the credit report, which I do believe they are starting to be shown on the credit report and not in a very good way, so stay tuned for the next video on that, but that will also affect you. So you're thinking you're breaking this one payment into 4 different payments or however many different payments, and you're doing this multiple times, that will still affect your debt to income. So if you have questions on how to calculate your debt to income and you need someone to take a look, let's contact me and we can walk through that together to see what kind of standing you're in.